Hello, I'm Nicholas Hyatt, Investment Manager here at Wealth Club, and today I'm joined by Rupert West of Puma Investments to talk about Puma VCT 13. Rupert, for those who aren't familiar, could you tell us a little bit about Puma and also about your own background?
Sure. Hi, Nick. Nice to be here again with you guys. For Puma, firstly, sort of what we do. We're a fund management business spanning growth capital and private equity, which is the piece that I run. And what we're sort of talking about today, we're in real estate and we're in listed equities. The business has grown pretty substantially since it was set up. A small team of us set it up 11 years ago, and it's now at about 100 people and about $1 billion of AUM. And we grew out of what is still our parent organisation, Shore Capital, which is a larger financial services business that's been around since 1985. In terms of how we do it, which I think is quite important for us and how we sort of go about things and how we feel about ourselves, we're a very active manager. So everything we do, we have a very, very active, rigorous, high governance approach. And it's working well for us in terms of delivering for our investors. So from the VCT's perspective, our VCT is the top performing in the market by quite a wide range of metrics. We were the 5th largest VCT fundraise last year as a manager, and we have had a very good year of investment. We've put away a lot of capital into 6 new businesses in the past 12 months, which has really allowed us to take advantage of some more attractive valuations in this market. And it's also working for us in terms of our own staff and the ability to attract and retain talent. We were earlier this year awarded a Top 100 Greatest Places to Work award within the whole of the financial and insurance space within the UK, which is obviously an enormous sector, so we're very pleased with that. But actually, there's a real meaningful and tangible benefit to our investor base for that, in that we are able to keep hold of and attract really good people, and actually fund management is quite a high churn industry for broad portions of it. So that's that's something we're really pleased about.
And your background?
I started my career at Arthur Andersen and then moved into investment banking, initially emerging markets and then UK based at Barclays Capital, and then into fund management. And I then launched Puma Private Equity, which is the division of Puma that runs the growth capital, including the capital from VCTs, in 2018.
And what does the Puma VCT 13 aim to actually deliver for investors?
So the VCT 13, I mean, it's really quite simple. It's intending to deliver good risk-adjusted returns to our investor base. So we think about that as a balance of taking risk to deliver positive return and mitigating risk to limit the damaging impact of losing money. So we are very much not either one side of that spectrum. We're not taking moonshot punts and accepting very high risk of failure, but nor are we trying to mitigate all risk and control, but not really have any capacity to deliver returns. So we are looking for broad, consistent return delivery to investors in a controlled and sensible manner by backing very solid companies.
And how does VCT 13 differ from your other VCT, Puma Alpha?
So 2 VCTs up and live these days, and normally one is open for investment at all times in the year. They work in exactly the same way, trying to deliver exactly the same thing, using exactly the same mandate. One is just a few years younger or earlier than the other, and we've set it up that way to allow us 2 things. One, if an investor wanted to come out of 13 and they'd had their 5 years, but they still wanted to retain exposure to all of the really very high caliber companies in there, they would be able to come out and go back into Puma Alpha. And 2, it gives us the flexibility to, if we ever felt that Puma 13 had become as big as was optimum for delivering returns to investors, we could stop fundraising into that fund, but still have a live, active, deep portfolio VCT that we were running.
And what sort of companies do you look for within those VCTs?
So my view on this is it's really pretty straightforward. So companies become valuable because they're able to deliver fast growth, good cash generation, or dominance of a market, sector, geography, whatever it might be. And we look really at a quite comprehensive matrix of things that we feel suggest an increased likelihood of companies being able to achieve all three of those things or one of those things and progress to the others. So we are really looking for companies that meet our view of what a company is that meets those criteria and will therefore be valuable to us and ultimately valuable to an acquirer. And that carries with it factors around the market size it operates in, the business model it operates in, and that's market size for the ability to be fast growth, business model and unit economics for the ability ultimately to generate significant amounts of free cash flow. And we are looking at management teams and screening them through a lens of, do they have the characteristics that will help their companies achieve those three things, or be as likely as possible to achieve those three things.
Could you give us some examples of recent investments that hit those key criteria for you?
Yeah, so as I say, we've had a very strong year for investment, and in fact a record year for us. So we've completed 6 new investments in the past 12 months in a market that, as you'll know, and probably many of your viewers will know, has been extremely low for VCT investment into the economy. One of those is a fintech business called Pocket, which is a very values-driven business. It provides digital controls, visibility, and access to the digital finance system that many higher earning people have become very used to with the digital banking revolution that was kicked off in this country really by First Direct, but then Monzo and Revolut, giving people a lot of control of their own finances and ability to participate in cheaper forms of financial activity. So, for example, having direct debits versus having to pay by potentially cheque, which comes with additional billing charges. And Pocket focuses on the 20 or so million people, as estimated by PwC, in this country that are underbanked. So they don't currently have access to that sort of support, that sort of provision, and yet they are most in need of that, and particularly in a time and climate like this, with all of the cost of living implications that we're all aware of, that is particularly relevant. And that is a business that is operating in a huge market, has taken some years and, frankly, a lot of other investors' money to get its unit economics working really quite attractively. And we've been able to come in and capitalise on market dynamics that are better for the investor this year than they have been for some time. A second business that we've invested in recently is a firm called Travel Local. And this came to market a few months ago and was very sought after by VCTs. It's quite a competitive process to secure this investment. It's a managed marketplace that sits between people who wish to go on holiday, but they wish to go on holiday in a more active, engaged fashion, and they want advice, they want a trip to be put together for them in adventurous locations, but they don't want an enormous, great holiday company to be really sort of taking the benefit from that and extracting that benefit from the destination company. They want access to local, knowledgeable, on-the-ground tour operators. And this company sits in between those two and is able to provide a sufficient service to both sides that it can take money, but also more money is still left inside the country of that is being visited, and is really sort of beneficial to all of the participants. So a managed marketplace model of which we've got a fair bit of experience in other sectors, and like a lot, it's a model that if you get right can really be explosive in exit value.
So what about the more established companies in the portfolio? How are they getting on?
Well, we're seeing quite a lot of success in our companies that we've helped move into the US market. I think that's a little bit, unsurprising given the relative strength of the US economy. So that's a fairly typical form of sort of growth and strategic support that we give. And the companies come to us, they're a little bit more a little bit higher level of commercial traction in this country when we typically invest. So for context on that, the average revenue of companies at the point of our investment over, say, the last 2 years is about £3.5 million of revenue. So they have some data and establishment and team presence here that we can really work with and get our hands on and sort of help them. And our typical approach is to sort of firstly slow them down and make sure that is all working, and then kind of build capability and then accelerate. And often part of that acceleration is geographic expansion. So for businesses that we've taken to the US, we are seeing quite strong growth this year. 3 examples. Influencer, which is an influencer marketing business, sort of tech-enabled, platform-based influencer marketing business. They are growing terrifically well in the US, having opened an office there in New York. A second business, Cameramatics, which is a fleet management, so telematics, fleet management business, but all video-enabled. Lots of benefits there in terms of compliance and insurance risk, but also in terms of monitoring to adhere to ESG requirements and also meet some of the visibility requirements that are now sort of regulated for in big cities. They're growing very strongly and winning large contracts over in the US, which is quite exciting. And then right to a direct-to-consumer business, Rondorf, who is men's clothing that has an omni-channel approach, so stores plus e-com plus wholesale, and we've helped them open stores in the last year or so in both New York and LA, and that has augmented digital growth and e-com growth, and the business is putting out really good like-for-likes, which for a direct-to-consumer clothing business is obviously very comforting and attractive in this climate. And I think also that just the wide range of those 3 shows the diversification in our portfolio, and really we do go out of our way to build and retain proper diversification, both by business model and sector, to really give us some protection to shorter term movements in the economy.
And putting just funding to one side, what else is it that Puma is able to offer to its investee companies? So,
as I touched on right at the beginning, our approach is incredibly active and engaged with these companies. We're very much, fundamentally see this as our problem rather than that's them out there, that's their problem. So we support companies. I mean, I actually see daily sales figures for most of our companies before I have breakfast, and we're quite on the detail. But that allows us really to be part of most significant conversations. So we support people in really all aspects of what they do, but where it really, I think they would say, hopefully, where it adds the most value is in the transition between systems as they're implementing systems and looking at how information flows around their company to help decision making. We get very involved with that. We help them put together KPI decks. We share with them the analytics that we run, that we benchmark across lots of different companies in different sectors. And then people. So building HR strategies, building the employer-employee proposition, attracting staff, building out the specs for those, planning forward to look at what the org chart should look like in some years' time, and then recruiting specifically for the roles. And that can be as seemingly simple as lending them, in effect, some senior resource from within Puma. So a business that we might have backed that has not yet had, for example, its own HR function, it's actually quite hard for them to interview for that role because you are inherently then a generalist interviewing a specialist, which is a little tricky and slightly easy to sort of be bamboozled by. But so we could help by having our people team be part of that interview process, and we do that frequently in that field, or with marketing, or with finance people. So those are some of the many ways in which we get involved to support the businesses we back.
So we touched on this a little bit earlier when we were talking about Pocket being an investment, that it's a very investor-friendly time to be making an investment in. But the market has obviously changed an awful lot over the last 12 to 18 months. Has that changed the way you invest at all?
To be honest, not really, because if you are running private capital into private, so fundamentally illiquid businesses, you cannot trade in and out. So it is quite a sort of category error to assume that, oh, this is how the market looks right now, I must react to that and pick certain different things, because if you do that, you can't then get out when the situation changes and you may have missed something. So you really need to look for things that have the core characteristics such that they will, on average, be more likely to be more valuable in 3 to 5 years than they are now. I think most people would probably, if you were to do any changes to reflect today's climate, you would be more active, but we already are, and you would help companies rebuild strategy, but that's something we do almost constantly. So we really haven't changed much at all, other than potentially pace of deployment. And we try to react to valuation. I mean, really, if there is one thing you can try and do, it is control your ingoing valuations. So last year, for example, first half of last year, valuations were extremely high. We did next to no new investment. This year, valuations have been much lower. We've done a record year for us of investment. And we're just beginning to see now some quite sort of panicked bidding from other funds that we come up against in offer processes, funds that have not deployed enough capital, and they are almost sort of buying at any cost. And fortunately, because we've been pretty busy over the course of this year, we don't need to participate in that.
It's always risky investing in early stage companies. When you make an investment, what percentage of companies do you think ultimately may not make it?
I think it's really impossible to say, and really we should be realistic about that, because it's a combination of environment and exogenous shocks and all the rest. What I would say is that in 5 years to date of operation for Puma VCT 13, we've had 2 successful exits already. We have had no failures. That may well not be an accurate indication of the future, but I would be pretty confident that on average, our active approach and backing businesses that have slightly more commercial traction at the point we're getting involved should mean that our failure rate is lower.
So you mentioned 2 successful exits. Would you mind telling us a little bit more about them?
The 2 companies that we've come out of so far, so this is across 5 years of operation, so 4 years really of sort of meaningful active investment. We've invested in 20 companies to date across the portfolio and exited 2. So they were a market-leading direct cremation business called Pure Cremation, which we backed and took a 4 times return on. It was a really enjoyable relationship with the management team there, and ultimately they bought out our stake and have gone on to then participate further in the growth of the business. And the second was a health and wellness app called TicTrac, which we sold to a listed acquirer, a Canadian telemedicine business, as it happens. That was for a 2 times return of our money, and really I'm extremely pleased with that. The other exit that's happened in that 2-year time frame from elsewhere in the Puma portfolio was a 3 times return, and that sort of 2, 3, 4, that is exactly what we're trying to do. We are not trying to take sort of outside risks, and we are not tolerating a sort of high failure rate in return. 2 to 5 times return consistently over time will do very nicely.
And what has that meant for the performance of the VCT overall?
Performance has been very good. We are, objectively sort of measured against other VCTs. We're sort of top performing over a 3-year and a 4-year and 5-year time frame. So that's obviously, very gratifying, and I'm pleased with. We've paid 3 dividends from VCT 13 to date, and again in a 5-year, for 5 years from launch. So pleased with that as well. I think, we work very hard at what we do, and coming back to some of the sort of the point of Puma and the culture and the positioning of who we are, we really take our sort of our fiduciary duties to our investor base extremely seriously. It's not to say we're sort of all awful, boring people who don't have any fun, but we do really strive to sort of deliver this performance. So we're pleased with that.
You mentioned the VCT is now paying dividends. What is your dividend target?
My dividend target is again, very simple, is that we will pay out returns from realised exits. We don't seek to pay out a consistent dividend every year by raising capital and paying that capital out. That does not make sense to me from an investor return perspective, either for the existing shareholders or for the incoming shareholders. So we will deliver dividends by realising positions and paying out proceeds.
So to sum up, Rupert, if I was going to invest in one VCT this year, why should it be the Puma VCT 13?
I would say that if you're looking for a VCT with a really good track record, with a promising and meaningfully diversified portfolio, so a portfolio of companies across different sectors and different business models, and a dedicated approach to that, run by a manager with a really active, rigorous approach, then we're the VCT you should pick.
Rupert West of Puma Investments, thank you very much.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.